Good day, everyone. Well, we see that the ECB has relaxed rates by 0.1%, which is less than what the market was expecting. So the European markets have sold off fairly substantially and taking the U.S. market down with it. But the U.S. market, being this tallest standing midget, is only down fractionally here. I think that based on its reaction to Yellen and other Fed bankers telegraphing that they were eager or interested in hiking rates in December when the Fed meets, December 13th, seems to me that the markets are betting that the economy is better than expected for them to take that kind of a move or that kind of a stance. But of course, we all know that nothing moves in a straight line these days at all, not even for moments. So now we have Yellen saying that the economy is very fragile, like we've all known, and that if they do hike rates, they're going to be very gentle about the progression of rate hikes going forward. So that's made the market a little nervous here. That said, the number of names that have come through in terms of pocket pivots and Bible gap ups, it's been a pretty good list of names. Those names still seem to be doing okay. And we've remarked in pre-market pulses and other reports that this market seems to have a real tough time going to new highs. When it does, it seems to do an about face pretty quickly. So this year has been made up mostly of trendless sideways action in a very sloppy manner. This kind of pattern is almost, or basically unprecedented in terms of the amount of volatility we've seen within the sidewaysness, which has of course made timing markets nearly an impossible task. But on the other hand, we have had some names do well, especially earlier this year. We had a slew of names that were playable, and to sell those into strength and context with their chart often allowed one to hold the stocks for a number of weeks while they moved higher, because a stock like, for instance, SKX would not get ahead of itself and manage to in many cases be held, or at least the bulk of its position to be held. And then we had a few other names like that have done well. So those are the kinds of names that if you did play them, you're probably up for this year. And afterwards, it's been a tougher road. But as we've always said, you've got to keep your stops very tight, especially in this environment. And we've had some examples of where sometimes the tightness, you don't want to wait for the moving average, especially if the markets are heading south, because as we all know, when the markets go even 2 or 3% lower, then they take the leading stocks with them a lot harder, and those leading stocks can give up what took them maybe 2 or 3 weeks to gain. They can give up those gains in a matter of 2 or 3 days. So it's been an incredible market in terms of being able to be disciplined and nimble in your approach. And over as far as the global economy is concerned, all these markets, world markets, most of them are off anywhere between 20% to a whole lot more. So they're all going through their own bear markets. The U.S. is the only one pretty much that seems to defy the rest of the world, and simply because the dollar is the strongest currency still, and the Fed, the strongest central bank, and it continues to print. So money's got to flow somewhere, and it tends to flow to dollars and U.S. stocks. So that keeps the market propped. But now that the Fed has, they stopped the QE process in late 2014, and so that, of course, the market now is, I think, running on fumes, and that's what the pattern that has come through this year is telling us. A very sloppy sideways jump pattern in the major averages. So basically, going forward, all the strategies still apply in terms of being very nimble, extra nimble in this environment. And as far as the global economy, you can see that oil is on the verge of hitting multi-year lows. Same with the Commodity Research Bureau Index. And in fact, I think with the Commodity Research Bureau, it is officially now, let's see if I'm going to pull up a very long-term chart of this one. Yeah, it's just literally 2 points 2 points away from, I think, all-time lows, or at least 35-year lows. So there is extreme slack demand on the part of commodities because China is having problems and other countries are having problems, and the Fed has really created a situation where they've used this quantitative easing to keep zombie corporations alive, that are not productive, and then at the same time destroying business models such as the pension funds because the yields are too low. And then, of course, it's turning the savers into, they're penalizing them because, and of course, they're getting penalized over in Europe where it costs them money to park their capital at a bank. And the Fed is resistant to do that, but we're that close. I mean, savers really don't get much for their money when it's sitting in a bank these days. So there's very little incentive in any direction. And we were talking about the demand inflation is really the measure that drives a successful economy. But there's been no demand inflation. It's non-existent because everyone's hunkered down and saving their capital, and so are corporations and banks. So we're in a real tongue-tied pickle here in terms of what central banks have driven the world into at this point. So at any rate, it never it's a waste of energy to get upset with what the system is. That's where we're at. So we got to keep our eye on the ball in terms of what stocks offer us, and when another uptrend does emerge in the majors, we'll be there. We'll be ready, waiting for it eagerly. And with that, I think I will turn it over to Gil. There's stocks we can talk about, I guess, later in the broadcast, and there was actually one question someone who could not attend today did have. And I guess I'll go over that real quickly here. They want to know how many positions either of us hold in this kind of environment. And the thing about that question is, it's not to be disrespectful here, but it's not a meaningful question simply because, first of all, my style is different from Gil's, which is different from a myriad of other types of investors. We all have our styles. Therefore, we have our risk tolerances. Some of us prefer to concentrate our positions in just a handful of names, and other of us like to spread the risk out. And in my case, I oscillate. I'll go into just a few concentrated positions, or I'll spread the risk out. And it all depends on what the market's telegraphing to me. And I can't predict ahead of time whether I'm going to be sitting on 2 positions or 10 positions. I will say that in this kind of market environment, I'm likely to have fewer positions just because there have been fewer opportunities. So that can be said. I suppose in a training environment, like we had in the 90s, I like to sit on a lot of positions to spread the risk out because I found that I could still achieve triple-digit returns even with that many positions. Where a guy like Gil likes to prefer, go for the kill with just a handful of names, even in trending environments. So the best answer I have for that question is find your approach. Find what works for you. There is no easy solution to trading the market if you're going to rely on someone else to do the work for you. You've got to figure this out on your own, and that's part of the fun and in doing all of this. And if you're not having fun with it, then you might want to have a professional run your money. And with that, I'm going to turn it all over to Gil.
Yeah, Dr. K, I just would have said it's kind of a dumb question because it doesn't really, it reflects poor understanding of the market environment, and anybody who's been on these webinars for a while knows that I can have 1 position, 2 positions, 3 or 4, and I may not have them very long. So I know a number of you showed up on Sunday for the stock hunting webinar, and if we go and look at, say, if you guys recall, for those of you who watched the video, I was basically focused coming into the new week. I was focused on 3 stocks: LinkedIn, Facebook, and CRM. All these stocks actually are, yeah, they're up a little bit today, so they're all hanging in there. And what I was looking for was a short little, a small pullback on Monday, which we got, and looking to buy into the weakness. And of course, that's what we got. Pull back here, and now these things have turned back to the upside. So if I'm going to buy stocks, I'm going to buy them on the weakness, and I'm going to go in heavy, and I'm going to look to probably trade them out at areas of resistance. So if you're looking at Facebook, yesterday hit 108, which coincides with this peak here. So I'll trade out of it. Comes back into the 20-day again today, so you could come back into it if you want to. And it's basically hanging out in a tight sideways formation, but it's just chopping back and forth. And so I'll trade it in there, and I'll trade big positions. I don't really get bogged down in this idea that I'm holding X number of positions and I'm building them into the rally, because in this market that's just a stupid approach, because all that happens is you end up getting up to your eyeballs in stock right at the peak. So if you've been watching these videos for a while, or these webinars, you understand that's been our approach to the market. And to try and take a longer term approach, a trend followers approach, is just a recipe for disaster. So, but I gotta admit that IBD now is starting to change their tune, because I saw an ad for their master's program, which is the weekend workshop, where they used to charge 15 grand, now they only charge 10. But you notice Bill O'Neill isn't showing up anymore, because he's having, I guess, some issues related to his age and his memory, and so he's not in the picture anymore. So now they have a segment on swing trading. So I guess now, like I was saying on Sunday, you're going to become a master of swing trading. A little more difficult than just attending a little workshop seminar. And I also think that unless you're using pocket pivots and other buy points within a base rather than chasing breakouts, I don't think you're making enough progress on a swing trading basis. So that said, I think you have to take a more active approach, and that's basically how I operate. So anyways, what are we looking at today? Yesterday we had a sell-off, and there was a bunch of news. Let's see, where's my NASDAQ chart? Here we go. Bunch of news, regarding an attack out here in San Bernardino, which is about 60 miles east of me, here in West LA. And Janet Yellen getting aggressive on, or being seen as being more hawkish, which I thought was kind of interesting, since I don't understand. Dr. Kim, maybe you can explain this to me. How can the Fed come off as being more hawkish when it's already assumed by the market that there's going to be a rate increase in December, this month, when they meet later on? So, I don't really understand that assessment.
So can you repeat the first part of that? Just the first few words?
Well, how is the Fed how are Yellen's comments more hawkish if the market already assumes that they're going to raise rates in December? And all she was doing is that she would favor raising rates if the data shows it. Okay, so what is that? That's really kind of nothing more or less than they've said recently. So where's the big where's the big reason for the market to sell? What was the sell-off all about?
Well, yesterday's, I think, after she started speaking, the market just went south, and I believe that the market's going to be very fickle. It has been, as we've seen this whole year. It can't decide for itself what it really wants to believe and what it wants to do. And so, in other words, it's going to use any excuse for, if it's perceived as something negative. What she said yesterday can be perceived as negative or positive. The market chose to see it as negative and sold off. But I think that in this kind of environment, the opposite could have also happened, and the market could have rallied on those words.
Right.
So, the fickle environment is, it's schizophrenic, and it is tiresome in terms of trying to find any sort of meaningful trend in the market. And this is one of those times when Livermore said, don't try. If he were alive today and trading markets, I think what he would have done is he would have been completely focused this year on purely stocks and been very, very careful about how he trades them, because he knows it's a tricky environment. But it's outside of that, I don't think he would have been doing very much, because it is one of those tough times. I mean, hedge funds, I think, this is one of the worst years on record. So. there's always an opportunity to make money in any given year, but sometimes it is better just, there are some periods of this year it's just better to sit on the sidelines and, wait for the lower hanging fruit when they do appear. SKX and a number of other names from early this year we saw were, nice lower hanging fruit that did pretty well.
Well, only for a little while, though. I mean, this was a Bible gap up, and then the thing blew not too long after the Bible gap up. That's where it is now. It's been a great short. So I would argue that if you look at a lot of the pocket pivots that we put on the list since early October, the majority have either gone nowhere, or some of them, like say this one or this one, have all broken down, and you've seen a number of them do that. What was the other one? Norwegian Cruise Lines.
I would say that it was early this year that SKX did, it was a champion, and a number of others. They did great, and that was where they had lower hanging fruit. Now, since October, there haven't really been any. The trees aren't bearing any fruit, in my view.
No, they're not.
It's been, I think, since late August. Basically, this market has been one of the toughest markets to trade. But I always remind myself, these periods always come to an end. So in the meantime, I'm going to tread lightly, and so that the gains made earlier this year aren't completely reversed back to flat. And people have to learn discipline of, if you're up 10 to 20% in a year like this year, you're doing great. Certainly beating most of the hedge funds out there. But now you have to be disciplined to be able to keep those gains if the market continues to serve lemons to us to the end of the year. And we only have another month left, so.
Yeah, so I mean, making progress in most stocks is very difficult. To me, it's more of a short-term trader's market. So, in that vein, someone's asking me, what did I see? Well, it's pretty obvious what you saw here on Facebook, for example. You break the 20-day moving average on an outside reversal, volume picks up right here, and that's 4 days ago on the chart, but it's below average, and it's undercutting this low. In this market, that tends to be what I call an ugly duckling kind of setup. There's a rationale to look at it as negative because it's an outside reversal day and the volume picked up, but the volume was below average, and you're undercutting a prior low in the pattern. So when you look at this, it's not really that big of a deal. If it had happened on huge volume, then maybe I'd have an issue with it. But as it turns out, it didn't, and so I'll buy into that, on the undercut. And I may look at the 620 chart, I may not. I just may buy it, and I think I bought it like 104.20. And you get a nice pop up to 108 yesterday, and you can sell into it and take your 3-4 points of profit and move along to the next one, waiting for weakness to buy into. If you look at LinkedIn, same situation. All it did is pull back into the 20-day moving average. It did that Monday. And bingo, you buy right there. Volume is picking up, but it's below average. But look at how that also looks a little bit ugly because it reversed. But within the whole context of the pattern, number one, it's at the 20-day moving average. So you buy it right there, you keep a tight stop, you run for cover if it doesn't work, and that's it. You don't need to see anything magical. It's pretty simple. As long as you don't think you need to overthink it, which most people I find are guilty of. They want to have deep reasons, or they want to be able to put something into an equation because they're too dumb to think for themselves, and they need something that they enter in the numbers and it spits out an answer, yes or no, black or white, buy or sell, and it doesn't really work that way. Somebody's mentioning, and I think this is valid as well, Dr. K, that the market sold off yesterday as a result of oil getting pummeled, and that's what happened there. It's testing, it looks to me like it's testing, hasn't broken this low, which would would that be a multi-year low right there?
Yeah, it pierced, it closed under $40 a barrel yesterday, and it's only a breath away from significant multi-year lows. Meanwhile, the Commodity Research Bureau is already, that's only a couple points away from, I think, all-time lows in the history of the whole index, which is pretty monumental.
Yeah, this, when did they bring this thing out? I'm pulling this out way back here. So it had to move up back in 2008 and then blew apart with the rest of the market. See how when we had the financial crisis, everything is getting hurled. and gold was getting hurled, oil, everything, commodities, I think everything was just getting hurled, and that's basically because you had a massive liquidity crisis, which I think you could have again today. I think it's sort of comical that Mario Draghi gets up there in such an authoritative manner and says there's plenty of bonds to buy. He's basically, every time these guys say they have to lower rates or engage in bond buying or any other type of QE, they're basically highlighting their own failure and the failure of quantitative easing. So it's all a bunch of BS. So you're in a distorted, choppy market. You got to be an active trader. If you're not, yeah, you might be making some money if you bought, say, Amazon on the Bible gap up here and have been sitting. And so far, it's acting fine. I think at this point, you might be 7 weeks into this. 1, 2, 3. You're getting to 7 weeks, so you could use the 10-day moving average as a guide, a selling guide, if this thing starts to break down. But so far, that's acting okay. And Google's another one that's doing the same thing, just kind of chopping its way higher after the Bible gap up. Palo Alto Network's another one that's moved higher after the Bible gap up. But they are getting a little long in the tooth. So if I'm buying any of these last week and watching this rally, you're coming back up. If we look at the weekly chart, I'm coming back up to the highs. I don't know, maybe it pulls a Netflix and breaks out to new highs and then rolls over. That's one thing I'd be watching for here. You know, I've talked about, if you go back to, say, late 2007, 2008, the market broke off the peak in October of 2007. And then it rallied back up and took about 2-3 months to do that, I believe. And you saw a number of leading stocks rally with it. And some of them broke out to new highs, like Apple. And then they failed. And so what you've seen now, you're seeing Netflix break out. You're seeing Palo Alto Networks heading for breakout. You have seen Facebook break out here. And they're, you know, it's holding in okay. But I would watch for failures here, because some of these, I think, become great short sale targets if they fail. And that's usually where you get some of the better shorts initially on the break off the peak, if that's what you get in the market. So under that scenario, you watch for that. Now, yesterday was a pocket pivot in Netflix, so it's moving higher. But I'm watching this because I think it could become shortable if the market rolls over. And I expect that if we are topping, it's not going to give it all up at once. It's going to do what it's doing today. We went down 100 points. Now we turned positive. We're turning back down to the downside, and maybe you know, that's going to be all she wrote. Maybe we head back for the lows, but expect it to be very choppy, because I think you're in a highly manipulated, highly distorted environment, and things are not always what they seem. You know, so that, I mean, that's the whole premise of the ugly duckling theory, is that when things look their ugliest, that's usually when they turn around and go higher. And so sometimes I'm just buying things on undercuts or whatever based on the ugly duckling theory. Did that 10 times fast. And looking to get a pop, and a lot of times you do. So I mean, that said, I'm up double digits for the year. Big deal, you know. It's not that much, and it's been very difficult. And you never have a real opportunity unless you go in heavy. So, you know, with the LinkedIn or the Facebook, I mean, the risk is that you're going to get pummeled here, and so I'm not necessarily going to go in real heavy, maybe 30% positions, which maybe for a lot of people is heavy, but for me that's kind of starter zone, 25, 30, and look for the move up, and that's all I'm doing. I'm not averaging up. So Facebook, same thing, and the third one was Salesforce, who actually is acting pretty well here. It bounced off the 10-day moving average this morning, and it's holding up pretty well. So that said, it could just be in a choppy range. If the market breaks down, it could, you know, come back and fill this gap, or it could just continue to move sideways. But it's going to depend on how December pans out, and I'm thinking anything could happen. I don't discount a Santa Claus rally, or the Grinch taking controls of Santa's sleigh, or even the ugly duckling taking controls of Santa's sleigh and just making weird things happen. Because you're in a favorable seasonal time of the year, and anything could happen. So yesterday's sell-off didn't surprise me. A lot of things reversed pretty hard. I'll give you, this is the danger of this market at times. Look at IPHI, Infi. This is a stock that's acting great, you know, moving higher. And if you're buying the pocket pivots on the strength, you're buying it up every time. So you only want to buy it on weakness. And yesterday it looked like it was going to hold the 20-day. and then it failed, and volume is real heavy. These guys came out with a $150 million convertible bond secondary offering, and they got hammered. And I was surprised by that. I actually tried buying it off the lows early in the morning. It jacked up a couple of points from there, and then it started to give way, and I unloaded it. But I was surprised it didn't hold up, whereas VA, Virgin America, they announced a 26 point something million share secondary offering, and this thing has a float of 19 million. So they're going to double the float, but yet the stock, it sells off initially, and I'll tell you what ticks me off. I bought a little bit of this here off the 10-day, and of course you're looking great the next day, and then they gap it down to the downside. So I sell it as it's bouncing off the lows, thinking I'm getting out easy, you know, and the thing just continues higher and closes near the peak, and now we're back up to Tuesday's levels. So I mean, what the hell is that? You'd think that this thing would be getting pummeled, but instead it gets pretty big support. The volume's pretty good and holds up. So you know what you think is going to happen in this market doesn't necessarily happen. I would have expected IPHI to hold up a little better. And maybe once they get the convertible price, it pulls into the 50-day line. If you look at this on the weekly chart, here's your breakout. This is your first pullback into the 50-day line. Maybe this is viable. So don't know for sure, but you know this is just what you're dealing with in this market. And so if you're going to enter stocks, you never want to chase strength. You're taking a big risk. It may work, or you may end up getting yanked the other way and shaken out, and you're better off having a lot of dry powder in your pocket ready to jump in. So when you say a highly manipulated market, are you referring to QE? Well, I think you've got algos in there going back and forth, and I think the QE just puts all this liquidity in the market that sloshes back and forth, and you see it in a highly rotational type of market where the best stocks and the best rallies come off the lower parts of the pattern. So it's more rotational than it is, say, a growth environment where you have steady accumulation of stocks. I mean, if you think about it, the period after 1981, when we started the new secular bull market that lasted into 2000, mutual funds were just coming into their heyday around that time, and you had the baby boomers steadily putting money away for retirement and investing it in mutual funds. So if you look at mutual fund flows starting around that time up till 2000, it's just a steady increase. So you got all these mutual funds being formed, money's just continuously flowing in, and now you have a situation where they just have to keep buying stocks and getting invested. So every pullback, every bear market is a time when they accumulate stocks, and you get new uptrends and everything takes off again. Now you're in a situation where the baby boomers have retired, and I would be representing the tail end of the baby boomers. I think it's Dr. K. Dr. K, you're not even in the baby boomers. You're one generation behind, right?
I have no idea.
Like, who cares? But in any case, the baby boomers are the largest cohort group in the history of the United States. So they're putting money into mutual funds, and that drives a fairly, when you look, even though we had regular bear markets, a fairly consistent uptrend over a longer period of time. So that's a secular bull market. And now you have a period where I think you're seeing money coming out of the markets, and the only thing going into the markets is the QE that's driving all this algo action, and big investment banks like Goldman Sachs and other people running HFTs, high-frequency trading funds. So it's become a market of, by, and for the algos. And unless an investor can think like an algo, they run the risk of getting whipsawed all over the place. And you see it, you know. Ron Brown, I don't know if you guys know him. He's from HGS Investor Software. He's in a CanSlim meetup group or something, online meetup group or whatever. And they're down, 8, 9, 10%. They just keep buying breakouts and getting stopped out 6, 7% down over and over again. And that's just a recipe for disaster. But, you just understand what the market's going to give you and you take it. So last year I was able to do triple digits. This year it's a lot tougher. And every time I thought that I could get a little more leverage up, they whip me the other way. And so I'm not making what I could if things had some sort of continuation to them. And that's just the way it is. So I'm just happy to be up. So I'll take it. Anyways, any other exciting questions? No, let's look at some other stuff. Okay, here's something I shorted this morning. NXP, right at the 20-day. If you look at this thing on a weekly chart, that's what it looks like. So it's a big head and shoulders. And now you're getting if you look at this, here's a fractal head and shoulders extending back to here. So there's the shoulder, there's the head, and how do we define that as a head? Well, you have a massive volume breakdown on the right side. So now you're getting a fractal head and shoulders. It would make sense that you're going to rally up to this peak and the 40-week line, and that becomes a short sale point. Bingo. It's heading that down, and that's one I would be. Well, I'm shorted, so I'm shorted this morning. And let's see, where are we at? I actually had a target on this. It may have hit. I'll take a few bucks. You give me $3-4 on something, I'll take it real quick and then look to reshort on a bounce. Yeah, I just took it. You're getting an extension and a turn on the MACD, so it hit the trailer, the profit-taking trailer, as I call it. Anyways, so that's one. Apple, I thought this is interesting. We got an email. I think you saw that email, Dr. K, from somebody talking about, you know, we're bearish on Apple, and some other guru that apparently this person who emailed thinks this person is a guru. Says that Apple is innocent until proven guilty. And I thought to myself, what the hell does that mean? I mean, that's what a pile of mishmash garbage that is. Apple is innocent until proven guilty. Well, on what basis? On a fundamental basis? If we look at the stock, every time it's had earnings in the past, well, so far since early this year, every time it's had earnings, it's reversed on earnings. Even though the number's always been very strong and they're touting their sales of this and that and the other thing, everything, and soon we'll have cars, although I really don't think they understand what they're getting into, but I would expect Tim Cook to screw things up eventually, because he's not Steve Jobs. I think Steve Jobs' greatest strength is that he was focused on the business, and you see these guys getting into their politically correct baloney, where Tim Cook, you know, talks about racism or something, sexism in some little town in the Midwest or something, and how they won't do business with people like. Meanwhile, they'll have their manufacturing operations in China where they have slave labor, or Middle Eastern countries where they oppress women. So they're all full of baloney. But when they start delving into that realm, you know they're just setting up to screw up. So I'm watching Netflix. I got a short out on that on the turn here. We'll see if my theory on this is correct. I'm also short Apple. So I think that what you're looking at is, if you're basing Apple on the fundamentals and the fact that it's, quote, innocent. I mean, what a stupid term to use for a stock. But typical of people who don't know what they're talking about. What you see here is a breakdown, and that's a sort of a climactic low there. But within the overall pattern, we've talked about this here. It's a big round head, rolling top, head and shoulders, where the head is a breakout failure here and a breakout failure here, and then boom. So it's a late stage failed base, and it's now turning into a big, ugly head and shoulders. Now, it hasn't been able to get through resistance along the lows of this base, which is around the 124 level. So in my view, that point is a short sale point. And it broke down from there, undercut the 10-week line, and has rallied back up towards the 120 level. Once I can determine, based on the last 2 weeks showing resistance at the 120 level, I will short it on rallies up into 120. And that's when I got shorted earlier this week. So now it's starting to break down. So this isn't a weak pattern. It's a late stage failed base, and it's merely rallied into resistance where it became shortable, and it still is. And the premise is still alive as far as I'm concerned, the bearish premise on Apple based on technicals, because we know that stocks top long before fundamentals start getting ugly. So that's another one that I think is just kind of exemplifies how stupid the statement is. And then if we look at it on a technical basis, it is most certainly not innocent until proven guilty. Right now, as far as I'm concerned, unless it can get through resistance at 124 in a meaningful way, then it is guilty until proven innocent. So, you know, that's my view on the stock, and I would look for a test of the lows somewhere down, around these lows in here, and we're heading that way. So stock had a little bounce right now, and could have hit it right there. NXPI is just continuing lower.
Like that, it shows that they've fallen in love with the stock, and one should never fall in love with any stock, because, as O'Neill used to say time and time again, all stocks are bad.
Yeah, and it just shows you some of the goofball emails we get from people who are just so utterly clueless. But it reminds me, I got a phone call the other day from a friend of mine who's a broker. And this particular friend he's pretty close. We're pretty close. So once in a while, if he's getting a new client on the hook, he'll call me up and ask me to get on a conference call with the client, or I'll have the client on the conference call. They want to ask me questions about the stock, and this guy He's talking about one particular stock, and he asked me where the 200-day moving average is, and I told him where it is. And he says, well, what's the time frame of the chart? Is it a monthly, weekly, daily? I said, well, if it's a 200-day moving average, it's a daily time frame. He says, well, is it a 3-month chart? Is it 1 year? I said, what difference does it make? The 200-day moving average is the 200-day moving average. And the guy's arguing with me, and I said to my broker friend, I said, what the hell? Have I died and gone to retail broker hell? Just listening to this moron. So at that point, he got off the line because I was ready to just rip this guy's head off, this prospective client that he had on the phone. But it just shows you so many people are just so stupid when it comes to the market. I'm never surprised by the kind of the stupidity we've run into, but whatever. I know I'm going off, but I thought that was a good story. Go Daddy is going. Then here you have a voodoo pullback into the 20-day. That's viable. You can test it there. If it breaks the 20-day, you're gone. And I think in any of these stocks where you've seen a pullback, they can be tested, but you got to be careful. Look at Facebook now. I saw Facebook rally. Remember earlier this thing was green, or not green, but well, green on my quote screen, but blue on the chart because it was up. Now it's reversing again. And now it's bumping back down towards the 20-day. If it busts the 20-day, it's going to the 50 probably, or maybe undercutting this low right here. And that could happen. But the trick here is it may be too obvious to buy right at the 20-day. It needs to do what it did here. So I figured I had an undercut 4 days ago that probably set up a rally. So I'm using the undercut and rally theory. And Apple turning red now. So I mean, I think this stock goes a lot lower. I could be wrong, but we'll see. So it's heading lower, 105.71. We're seeing it print right here on the right side, and maybe it busts at 20-day, which is at 105.29. It got all the way down to 105.27, so it barely undercut the line. But if you had bought it right at the line, you could have made a quick buck if you want to trade it that way. But this is a day trader's market mostly. There's just a lot of day trading madness that goes on. And all right, that is actually a what do they call them? A little drink mat thing that's sticking to the bottom of my cup, and then it falls on my keyboard. So they need to fix that technology. In any case, why, unless you're managing money for the firm's client, I'm not sure why your broker firm would put you on the phone with this prospective client. He does it to impress people, so I'm not going to say who it is. I may be a compliance violation, but the guy wanted to ask me about some stupid biotech stock that's got no earnings, and it's going up because some phase 1 trial was showing promising results. That BS. You get that all over the place. Somebody says never underestimate the power of human stupidity. I think it was P.T. Barnum, somebody who said nobody ever went broke underestimating the intelligence of the American public. So, and remember that Jonathan Gruber, who is the architect of Obamacare, who both Obama and people like Nancy Pelosi were bragging about their research back when they were trying to get Obamacare passed, is showing how great Obamacare was going to be. He was caught in a couple, 3 videos at conferences talking about how they relied on the stupidity of the American voter to pass Obamacare. So, yeah, people are dumb, and they can be taking advantage of that, right, Dr. K? Let's see. Okay, we know. Is that the cause for the rally, Mark? Yellen just said the Fed could always lower rates after raising them. It could, and my guess is it probably would. The bottom line here, I think, is you just have a weak global economy. China isn't really kicking in. We see weak PMI numbers, I think, on Monday. That might have been what brought the market down. And so we're getting to this point where, we can see that the economy is still weak. There's nothing constructive on the global front. The Eurozone continues to have to lower rates to negative rates. I love that. Maybe we'll get there here in the U.S. But what is it really doing? It's not doing anything. So I think it all will come back to what the global economy does and whether there's anything really worthwhile going on, or whether we're set for a sort of a global depression, and you'll see that in the markets first. So let's see. I'm seeing some other stocks giving it up a little bit too. Twitter might be one to keep an eye on here. We're rallying up towards the 20-day line. I don't know, there's some buyout rumors on it. It's actually up today. You have Luxoft moving higher. It's sitting off the 10-day line. It has tried to break out before, and it fakes you out now. It's trying to move higher. if the market comes in, it's a thinner stock, it probably comes in. I'm watching Infi come in. It's trying to hold the lows. LinkedIn holding the 20-day moving average. See, so if you like LinkedIn, I don't see anything really wrong with, say, testing along here with the idea that if it does break the 20-day, you're going to disappear. But something to keep in mind here, and I get your input on this, Dr. K. You can see that the stock has really gone nowhere after the Bible gap up on October. What day is that? What was that date? There it is.
It was
October 30th. Okay, so it's gone nowhere since then. Is that a problem as you see it?
Well, I mean, in context with the general market, if you look at the Nasdaq, the Nasdaq outdived in mid-November, and LinkedIn was able to hold its ground, which is a sign of strength. And the market really hasn't done much. So, relative to the market, it is showing some strength. But at the same time, you know where your stop would be, and the stop would be at the low of undercutting of the low of the Bible gap of the day. So that's not too far from where the stock is right now. If you believe the market's going to go higher, this thing will probably go higher with it and probably outpace the market. On the other hand, if the market gets weaker, then you probably should be in cash because it will take down most stocks with it.
Yeah, so we'll see what happens. So I guess the market was rallied after Yellen said they could lower rates after they raised rates. But what does that all tell you? My aunt could become my uncle if she grew a certain part of her anatomy somewhere. What does it really mean? I mean, what it really means is that they really don't know what they're doing, and neither does the ECB. They don't know what they're doing. That's why it's almost comical when Mario Draghi gets up there and authoritatively talks about how, almost like wetting or foaming at the mouth over the prospect of buying more bonds. I mean, plenty of bonds to buy out there. I'm sure there are. I'll loan you money if I don't have to pay you back too. So, or you can loan me money. That's what I mean. If I don't have to pay you back. Anyways, so what do you guys want to look at? You want to look at short ideas? You want to look at long ideas? You want to look at online porn? You tell me. So, looking at some here. This is one we got a question on. ANET, Arista Networks, trying to round out, but look at the weekly chart. Is that something I really want to buy? It doesn't look all that constructive. On the daily chart, maybe it wants to move higher. Maybe not. I would be very skeptical. Here comes Twitter rolling around. Let's watch the 620 on this one. Where is it? I think Twitter's a short eventually. So, and putting a little here. Let's see what happens. Kind of get a reversal on heavy volume up on the rally. So I'm not sure what that's all about. But this may, we're getting a little extended on the MACD, so it may want to reverse here. Keep an eye on that one here. But the way I see it, you got this thing, if you look at a weekly chart, this is an ugly pattern. So I guess there is always potential if the market went nuts to the upside that this could rally back to the 50-day or 10-week line from here. But what do you see? If you look at this, you've got basically a little fractal head and shoulders here forming, and you're right along the neckline probably, something like that. And you're just seeing a little bear flag, and you're pulling to the lows or the highs of the range. If you flip it upside down, it would be the lows of the range, but it's not really going anywhere, so it looks like it's potentially in a bear flag here and could roll over, so that should be watched for. So we're seeing the market gather some steam on the downside. Somebody else come up now. I wouldn't buy this stock. I don't know. It's kind of thin. Is it? No, 1,000,002. It trades okay, but it's way up there. I think you had to buy it down here. Let's look at this. It comes out of this sloppy looking base. I mean, look at the base. It's so sloppy. Just loose, wide, all over the place. No tight areas, no tight ranges. And then it just continues higher. Here, I'll try to make it look tighter. Whoops. I'll make it look tighter by doing this. Well, look at how it tightens up there. Is that looking a little better? But it's somewhat extended at this point. You're about a little over 10% extended from the breakout point. So what are you going to do? Buy it up here? No. SAIC, what is that? Science applicants. Well, it's straight up off the lows. You're going to buy that? Is this one a money losing? You want to check this one, Dr. K? Is this a money losing biotech?
Let's check it out. We've got. No, it's been earnings have slowed down the last couple of quarters, but it definitely makes money. And
Yeah, but are you gonna buy that?
Not a chance.
Now, if
There's
you're
nothing. I
getting
mean,
on
the
it
patterns
here,
are
maybe, you know,
X.
here's a pocket pivot down here. If you had gotten on it there, maybe you had a better chance. I think see some other pocket pivots. One here, one here. So there were some pocket pivots down here. Now I think you're kind of getting up there. So who knows? You're buying extended. So in this market, that can be no sell. I already own. Okay, so sell it. Take it, Sam. Ulti. Now, Ulti, here's another one, pocket pivot, break. It's going nowhere. It's holding the 10-week line if you look at it on a weekly chart. We looked at this over the weekend, but it's not getting up and out of here, which I think is a problem. And I'm not buying this one. So it's also trades 267,000 shares a day. I mean, that's better because it's a high price stock. So, you know, a certain percentage position don't have to buy so many shares. So that, you know, but am I going to buy it? I guess if you wanted to buy it here and use the 50-day line as a stop, you could. Yeah, Dr. K?
That particular stock, that Alti, if you observe that it many times has sat on the 50-day, pierced it, and went lower, undercut. So, you know,
Yeah.
it looks tempting to buy it here, but it's not really. If you look at the price history of the chart, it treats the 50-day with no respect.
No respect. That's right. So, you know, I don't know. Gilead short, someone's asking. I thought Gilead was a short, and I think we talked about this over the weekend on the breach. You got the breach of if it breaks the 200-day line, then you're shorting it there. Now you're breaking the 50-day line. It looks like it's heading lower. So theoretically, you could short it here, use a 50-day at 104.14 as a guide for a stop. But the thing to consider also is that you're 4 days down. So you might sit around waiting for a rally first rather than getting all excited to short it here because you see it down. Doesn't mean it can't go lower. So, you know, there were several banks, including I think J.P. Morgan and Goldman Sachs also, that were downgraded by S&P because I guess there's certain requirements that the government's imposing on them. And so a lot of these things have rolled over. If you look at the XLF, it's sort of rolling over, but it's been trying to rally because it can't figure out, but it doesn't because it can't figure out whether the Fed's going to raise rates or not. So that's one clue that there's still a lot of uncertainty over what the Fed's going to do and whether it's a one and done situation where, as Janet Yellen supposedly said today, they could be lowering rates after they raise them. So, you know, let's just bounce it around, turn it into a bouncing ball. I'm sure the markets will love that. But you can see it in the XLF because they're just chopping back and forth. You had a move up back with the market, okay, when the market came off its lows in this late September lows and rallied, so they moved up along with everything else. But they're not looking so great, you know, on an individual basis. You know, Wells Fargo looks like it's going to roll over. J.P. Morgan looks like it wants to roll over. But the caveat here about trying to short these is that if the Fed comes out and says, oh, yes, we are definitely raising rates, they could pop in your face. And so you don't want that, so you don't play. Fed is a piece of garbage and really nothing to even think about. So there's nothing there. So I'm not even going to, I don't know if I'd short it. I don't think you can borrow shares anyway. So not really into that either way. Let's look at what NXPI is doing. Continuing lower. After I cover it and take my profit, it's guaranteed to go down at least another 50 cents to a point. But I'm looking for an intraday bounce later on. May not get it, but there are other things to hit on the short side here. So let's see. Tesla. I think Tesla is still a thematic short. This is what it looks like on the weekly chart. I mean, do you see anything that looks anything less than a short on that chart? You're coming into this area of congestion here. So you could consider this a little left shoulder here, right shoulder, a head and a right shoulder. And now you're forming a lower bear flag. And it has found resistance in this area. You notice you're coming into this area of congestion, so it can push into it a little bit and pass the 200-day moving average, which is exactly what it's doing. So I think if you're shorting it, you're probably using the high of yesterday at 231.23. No, what is the high of yesterday? Is that right? 238.60, yeah, as your stop. But it could push a little higher. So, and you can see the congestion area on the left side right here. So, and you might kind of just draw a big zone over here showing This is more, it's a fuzzy area of overhead resistance. So TXN, someone's asking about. It's just holding tight. You had a pocket pivot 3 days ago, so it's holding tight. I mean, that's what it looks like. So it's straight up off the bottom. Chances are it needs to go sideways for a period of time. So if you think you're going to buy and make a bunch of money here, I don't know. Not likely, probably. So let's look at Intel, for example. Here's another big chip stock. And it's holding tight sideways. But look at it on its weekly chart. You've rallied all the way back up to the peak of the left shoulder in the head and shoulders pattern. So is it going to just continue higher, or is this likely after this big rally to roll over? And you're seeing this in a lot of patterns. Like NXPI is the one I wanted shorted this morning, and I've already taken a quick profit in it. See, that gives me a little cushion here to deal with right away. And that's what I like doing, is building a little cushion right at the outset. I did this in late July, early August, and then I was able to capitalize on the August break that way. But you can see these patterns don't look so great. Avago is rallying today. I guess they came out with good earnings. That's a little better. It's more of in a viable gap up position, and it hasn't broken down as much as something like NXPI or SWKS, Skyworks. So it's in a weaker, it's in a better position, and that is not one I would short just yet. I might keep an eye on it because this could fail. What are our thoughts on Tesla? I already talked about Tesla. So let's see. What news subscription services do you use? I mean, the only one I subscribe to is briefing.com. Otherwise, the internet is where I get most of my news from. So imagine that. Somebody says, for instance, I've been in VA for 6 days, and the first place I saw the secondary stock offering was when you sent your message out. Yeah, no, that was on Briefing, actually, I believe. So Briefing's pretty good. You take it, right, Dr. K? We both get it. It's like
I've enjoyed that for many years. It's very good. FinViz is another one. A lot of this stuff is free. That's just the nature of the internet. So, those are a couple really good ones. And of course,
yeah, let's look at. How about if you just do this? Here's a press release. No, wait, where is it? These are all old, so nothing new. Anyways, that's where I saw it. Let's see. Can double check that. FID. Yeah, this is on December 2nd. According to briefing.com, they filed for a 26.529 million share common stock offering by selling security holders. So insiders are unloading. Anyways, let's see. Did Amberell come out with earnings? They come out today after the close, right? Yeah, this one's been trying to turn, but I wouldn't be stepping into this. You might just be stepping into a big pile of doo-doo. So I would be wary of that. Let's see, any other questions? It's 8:56. We're getting to the end of the day, or end of the webinar, rather. And Fortinet, I don't know. This is not really sure. I would look at a rally up to 38.20 as a possible short sale point. You saw that, you had in Mobileye, after it broke down and had a couple of tests of the prior low here, it rallied into the 50-day. So when they get down and dirty, it's either the 20-day or the 50-day. Notice how Mobileye has been weak along the 20-day moving average. So that would have been a short sale point in the near term. So. How about some of these here? Let's look at Splunk. This is looking pretty weak. You had a big reverse. So I think the time to short this, see, because look at that. Look at this pattern. So it gaps out on earnings, and it comes right up into this area of overhead congestion. Let me make the chart a little smaller. So you kind of want to watch this. How do these things, when they gap up, where are they heading? If you look at this, you can see that stock gaps up into overhead. It's not precise. It looks like it's 66, but it's not, and it goes a little higher, and maybe $1.50 higher, and then it reverses on an intraday basis. But you could have been watching this on the 620 chart, and then hit it on the short side when it failed. So, and that would have worked. So I'll watch them, when they're coming up into overhead resistance. And I'll tell you, I was stopped out on NXPI earlier this week. I thought once it filled this gap, it might just fill this gap, and that would be resistance, and it would turn. So I went a little short a little bit. When it didn't work, just covered immediately and let it rally to the 200-day. Now you're coming up into a spot where you do have an area of overhead resistance, and you do have prior peaks in a fractal head and shoulders. So you can kind of put one and one together here and come up with logical short sale points. You might be a point or two off initially, because a lot of times they'll just slide right past, so you can't really tell for sure where exactly they're going to stop, but it's a reasonable way to come in on the short side. So I'm looking at Facebook still coming down. So this is really I don't know, but you could buy this here, I guess. What's the volume rate so far? Let's take a look. Okay, doesn't like me. Let's go.
I'm seeing it minus 19%.
Yeah, I've got minus 17.8, so close enough. And that's what you get with Wanda for $25,000 a year, and I can get this for $599 a year. So, little savings there. Avago equals BGU. Well, I was talking about this, is that it looks like a buyable gap up. It might be better. So if you want to buy it, I guess you could if you want to test that. Otherwise, it might not be, it may not work, but it looks like it wants to, or it could be a late stage breakout here that fails. So let's look at this on a longer term basis. Stock's had a big move. So, is this a fresh new breakout in a fresh new bull market? I don't know. Surprised nobody's asked me about Biogen. No more questions, huh? So, on the short side, I think there's some things to look at. UA, I thought was a short this morning, and use the 200-day as a stop. Bingo, it's breaking lower. Price line probably needs to be watched. It's rallied to the 20-day moving average, and that has been resistance here. See how this one filled the gap? It filled its gap. That's where it found resistance. It coincides with the 20-day. So you got to put this one together and come up with potential resistance here. So you'd short this using the 20-day as your stop, and that's what a 1294.38. So that's a possibility. Nike is whoops. I don't know. It's a little bit up there, parabolic. I don't know if you're looking at a new base here that you want to buy into. It looks straight down, straight up to new highs. That looks a little bit suspect. So I'm not really a buyer of that. So EA is a short. That's feasible because you have a late stage base and it's failed. So now it's right up into the 50-day moving average. And that could turn out to be a very shortable area. So that can be tried out. I think you have the right idea, definitely. See how you break out and then you fail, and so it's a late stage failed base. You get a couple of rallies. Now you're starting to find resistance around the 50-day. You see how you come down, you break down through the 50-day, you bounce off the 200-day, off of these lows, then you rally back up. This is pretty typical. So when you get that first breakdown, you usually want to be taking your profit and then waiting for the next rally back up. This goes further than any of the moving averages, but that's because it occurred during a general market rally. And so a lot of times these rallies coincide with a general market rally, and so you have to be keeping an eye on that as well. So context is important. And then when the market rolls over, they have a shot at working. So that's in position. You could use, figure out where you're going to use your stop. And you definitely shouldn't be doing it just because I say it's okay. You should understand the setup, the parameters of the setup, where your stops are, where the stock could rally to. Alternatively, if the market were to find its feet and continue higher, this could push through the 50-day and go as high as these highs. That could happen. So you don't really know, but you're going to play it as it lies and set your stop. And if it did rally back up to 74, that might be another place to come after it again. I mean, I did the same thing, similar thing with NXPI, where I short here and then I notice it's not working, so I go away, I cover, and then I can put it out today right near the 200-day moving average. So, and what's it doing now? Down, pushing 90.50, somewhere around there. Anyways, one of the things to note on the indexes is that you had a reversal here 4 days ago on Monday on higher volume. So that's an outside reversal. That looked ugly, and then the market turns and goes higher. Volume is above average, and then it picks up yesterday, however, and you reverse. So these are two distribution days off the right side of this V-shaped little pattern. Now you're breaking through the 10-day moving average. My guess is you're heading lower, and you're going to test at least the 50-50 level. Could be more. You could be topping it, and to understand whether that's really what's going on or not, I think you have to watch how some of these big stock leaders are acting. And so I would think that you might, whoops, I don't want to do it on that chart. You might see some of these breakouts like this start to fail. And that is kind of up there too. And so you'll see more of that action. That will confirm that we're getting into some trouble. Because last time we rolled over back in late July, we saw the breakout in Apple fail. Remember, right here? That was after a great earnings report. And of course, this was after a great earnings report, and it's just not holding. So I think that's something to watch out for. Watch for a fresh batch of failed breakouts among leading stocks that are acting really well right now. So, you got a few ideas to work with here on the short side. Still watching the Twitter here. Come on, baby. Let me see if I can. There's Apple. So you got the 620 sell. It gives you a little buy signal, but usually that's not enough for me to trigger a cover point, because I'm playing this based on being short up here. So it's come straight down. I'm looking for a breach of the 50-day moving average as confirmation of its weakness. And I think the setup is there. We looked at it on the weekly chart. And when you see any of these stocks rallying, and they're going nuts, and they've been stocks that were ugly, back in August, I think you got to look at the weekly chart and see where the major points of resistance are, because you're going to get short sale clues from this, okay? This is where you're going to understand the macro pattern. And we know also, if you guys have read the book, our newest book on short selling with the O'Neill disciples, which I really think should be Owl disciples, but whatever. Wiley thinks it markets better. So you can see that the rally here right into overhead resistance, and now it's starting to break down, and if the market breaks down, it's going to roll over. And we know that when you see these kinds of rallies, this occurs on a market break, and then the rally occurs on an ensuing market rally, and it sets up a new short sale point, and the new short sale point starts to work as the market starts to weaken. So I think Apple is also a case unto itself, in that I think it's a macro situation, and maybe like in terms of their business, it's just slowing down, it's too big. And there's a slowdown in China, whether the Chinese want to admit it or not. And I think that is an issue for the stock going forward. And it may be like it was in 2012 when it topped and the general market turned higher early in the year in 2012, but Apple just kept going lower. Last stock, what do you want to know about SFM, Scotty? Should you buy it? Sprouts Farmers Market. I shop there. It's like a Trader Joe's meets Whole Foods, so not as crowded, not as trendy. You own it already off the lows? Obviously, Scott, you probably bought it here, right, at 20? So, anyways, yes, Scotty and I are on a first-name basis. We've actually broken bread together at the HGSI conference dinner. So have you gotten married yet, Scotty? How about it? What's going on there? Anyways, you can tell me later. anyways, that's all I've got. You can see there's some things to look at on the short side. There are some pullbacks that might be viable. I'm watching Facebook just keep moving lower now, and it's back. You can see here, let's make this nice and big. I like big charts, and I cannot lie. You're right at the 20-day line. You're coming down to 105.36, and the 20 line is 105.26. You're a dime above. This might break. So, you know, if you thought it was going to turn, you're buying it at 106 and change a little while ago, I think when we started this webinar, well, now you're underwater, and it was a quick trade off the 20-day on an intraday basis, but that's all you get, and that's the way this market seems to roll. So it's a pain in the butt, I know. It's difficult. If you're a trend follower, then like Dr. K said, just wait. Eagerly wait for the next bull market. It will come. And maybe if you want to try, I think we're going to have a doozy of a bear market when we do. So I think the next MDM sell signal, there may be one coming up that I think is going to be a doozy, and a lot of money is going to be made on that. So those are your options. And I've given you some stocks to look at on the short side. I gave you guys a couple over the weekend, and I think some of those are panning out. But you know, those longs that I took on Monday were quick trades, and I'm in and out. Take my money and run fast. Anyways, yeah, there will be, good point, Scotty. There'll be another HCS Investor Conference in March of next year, and I plan on being there again, as I am every time they do them now. And I don't make any money doing it, so I'm not really a marketer, you know. I think 90% of the people out there in this business are marketing. Like, I think IBD has just become a big marketing organization, and with Bill O'Neill out of the picture, there's really no market brains there. And I know Lee Freestone, who's a very sharp guy, is most likely to just kind of take all the money he's made and just hang out and trade his own account and not get involved in anything. So I think they're sort of listless without a rudder, and or is it listing without a rudder, and they become a big marketing organization. So, but that's what's so common in this business, and I don't really care much for it. So that's all to say, we're not really big marketers, are we, Dr. K? We fired our publicist.
Never been really our thing. You know, we already have our bailiwick, which we're passionate about, and why do anything else?
Right, exactly. So if you build it, they will come, and they have. Anyways, you guys, have a great weekend, and good luck today. I think this is going to get worse. Maybe we'll see if I'm right. I'm playing it that way. So, and I'm actually short right now. I got a short out here on Twitter. I got a short on Netflix earlier on this rollover watch. Let's take a quick look at the. Let's see. Here we go. See the cross here? We had a rally. You got an extreme move. Now here again, see, this is where you get a small clue. See the MACD lines here on the histogram? Let's see if I can make this a lot bigger here. You guys can see it. Down here you can see these are lower than these, and then you get a cross. So that happens right about here. So you can start putting it out right in there. And it bounces once off the 20 period line, and now we're going through. Looks like you're going to get a sell signal. We'll see what happens. But remember, I'm shorting this on the basis of my theory that in the same manner that we saw Apple break down on a failed breakout attempt back in late July, if we get another leg down in the market here, then you're going to see other leading stocks that have been rallying and breaking out do the same thing. And Netflix would be a candidate. So Palo Alto Networks might be a candidate. So keep an eye on those, and those will be key clues, I think, in terms of where the market's headed. Because if you start to see a mass breakdown, if you see Amazon start to break apart, if you see Google start to break apart, then I think, and you're almost sort of seeing that today, LinkedIn comes apart, and it's still finding support at the 20-day line, then that might mean we're looking for something more severe in this market. Okay, so if you're long anything and you're up, just know where your stops are, and you know, put some in the bank. It is, after all, Christmas, Hanukkah, Kwanzaa coming up, and you need money for gifts. So that said, you guys have a great weekend. We'll catch you next week.